Good morning, and the committee will come to order. Today we will receive testimony from Federal Reserve Chair Janet Yellen regarding the Fed's semi-annual report to Congress on monetary policy and the state of the economy. Welcome, Chair Yellen. Promoting economic growth remains a top priority for this committee and for this Congress. I've been encouraged to see federal agencies and stakeholders carefully and thoroughly evaluating current laws and regulations. Since the last Humphreys-Hawkins hearing in February, there have been numerous developments that will impact economic growth legislation. Senator Brown and I have solicited the public for economic growth proposals, and more than 100 submissions from individuals and stakeholders have come in. They are listed on the committee's website for those who may be interested, and we are working together now to put together legislation dealing with it. The committee has held numerous hearings focused on economic growth with financial companies and regulators. Federal financial regulators issued their second IGRIPA report, and the Treasury Department issued its first report on core principles of financial regulation. In addition, members on both sides of the aisle have expressed interest in finding ways to help our economy improve. Support for bipartisan legislation promoting economic growth continues to build. Particular interest has been focused on finding bipartisan solutions to tailor regulations, change the SIFI threshold, exempt certain firms from stress testing, fix the Volcker rule, and simplify small bank capital rules. These are just a few of many issues raised to the committee in recent months. Imposing enhanced standards designed for the most complex systemic firms on institutions that are not systemic has real-world implications. I regularly hear from Idaho businessmen and women who are concerned about access to business loans that would create jobs and promote a healthy economy. The $50 billion SIFI threshold, particularly, is an area which we should address. There are different ways enhanced standards could be applied, and all too many have questioned whether the $50 billion threshold is appropriate. Chair Yellen, the Federal Reserve Governor Powell, Acting Comptroller Noreika, former Federal Reserve Governor Tarullo, and former Comptroller Curry have all expressed support for changing the $50 billion threshold. In addition to the $50 billion threshold, Federal Reserve Governor Powell recently shared specific areas where the Fed believes some laws and regulations can be changed to alleviate burden, including the Volcker rule, stress tests, and resolution plans, among others. I look forward to working with the Fed on these issues and welcome any additional color that you, Chair Yellen, can provide on areas where the Fed and Congress may act together to further reduce burden. With respect to housing, reforming the housing finance system is one of my key priorities this Congress. I've repeatedly stated that the status quo is not a viable option. The current system is not in the best interest of consumers, taxpayers, investors, lenders, or the broader economy. I was encouraged that Federal Reserve Governor Powell gave a speech last week in which he said that the status quo is unsustainable. He also noted that as memories of the crisis fade, the next few years may present our last best chance to finish these critical reforms. With respect to monetary policy, the Fed has now raised interest rates 4 times since 2008. Overall, the Fed maintains an accommodative monetary policy with a balance sheet that still stands at $4.5 trillion in assets. Last month, the Federal Open Market Committee issued an addendum to its policy normalization principles and plans, detailing how the Fed will gradually reduce its assets. I welcome more comments from Chair Yellen about the state of the economy and the path of monetary policy. The committee continues to work to find bipartisan fixes to address many of these issues outlined here today, and I look forward to working with Chair Yellen, the Federal Reserve, and the members of this committee. Senator Brown.
Thank you, Mr. Chairman, for holding this hearing. Chair Yellen, welcome back. It's wonderful to have you here and to see you again. Thank you, and thank you so much for your service. Since your last appearance before this committee, the Fed has increased the federal funds rate twice. Employers continue to create jobs, although at a slightly slower pace than last year, and wages have increased modestly. The Fed continues to lay out its plans to sell off the securities that it purchased during the crisis. The biggest banks are making record profits. important to remember that. The biggest banks are making record profits, just past the Fed's 2017 stress test. At the same time, too many Americans continue to struggle to make ends meet. They worry their children will not have the economic security that they once had. Life expectancy in many parts of the country is falling, something more or less unprecedented in recent history. That tells us something about our economy. So I'm troubled by what I'm hearing from the administration, from some Republicans, and from some in the banking industry. Even though a fifth of homeowners with a mortgage are still seriously underwater in cities across Ohio, you and my colleagues have heard me say on this committee that the zip code my wife and I live in the city of Cleveland, zip code 44105, had 10 years ago more foreclosures the first half of that year than any zip code in the United States of America. I see the difficulty that people in my neighborhood and my zip code have in rebuilding their lives. Even though the wealth gap between white and black families is widened, the administration seems to want to let Wall Street gamble with the financial futures of working families once again. Gutting protections for working Americans is back in style in parts of Washington. From the Treasury Department's report to the Financial Choice Act to the House's Financial Appropriations Bill, we face a slate of nominees for watchdog politicians who are, with great apology to President Lincoln, who are of Wall Street, by Wall Street, for Wall Street. 10 years ago, Chairman Bernanke sat in the seat that you occupy. After describing the economic conditions in the housing and business sectors, he told our committee, he spoke about concerns about subprime mortgages and global economic trends in consumption and labor data, but he concluded, quote, overall, the U.S. economy, this was 10 years ago, overall, the U.S. economy appears likely to expand at a moderate pace over the second half of 2007, with growth then strengthening a bit in 2008. We must not forget what actually happened next, this devastating financial crisis. Working families in Ohio and Nevada and Maryland and Arkansas and all over. Working families across this country can't forget that. They're still digging out, nor can we forget it. Collective amnesia on this panel aside. I mention this not as a criticism of Chairman Bernanke. He had plenty of company in missing the signs of an impending crisis and a impending collapse. But when it happened, he took aggressive action, all of you did, to confront that crisis. He learned the lessons that came at such a high cost. After the crisis, we put rules in place that strengthened the capital position of banks, that provided more stable liquidity, that improved protections for consumers and for taxpayers. Lobbyists are using the success of these reforms as proof that they should now be gutted. They're arguing that the results of the Fed's stress tests prove that we can now relax the rules. Having passed the test once, they want to make the test easier. I'm sure every college student you taught in your long, distinguished academic career, Madam Chair, I'm sure every college student you taught who struggled in class would have wanted the same thing. But they, unlike our nation's biggest banks, would have been too embarrassed to ask their professor. The financial crisis was caused in part by watchdogs who were busy focusing on bank profits instead of ensuring that banks were treating their consumers fairly and had enough capital to weather a downturn. Everyone on this dais can agree there are parts of Wall Street reform that could be improved. Of course there are. But our focus should be on growing a stronger economy for everyone in every part of the country, from Idaho to Ohio and beyond, and particularly in communities too often forgotten in this town. It means protecting consumers. It means improving the economic security of communities of color. It means strengthening the working and middle-class families who felt the devastation the most, the devastation of 2008's financial crisis. It means lowering the cost of health care. It means investing in infrastructure. It means expanding educational opportunities and job training. That's how you spur long-term economic growth that lifts up all Americans. Instead, weakening safeguards to boost bank profits and crossing our fingers that Wall Street will invest some of those profits in the real economy, we hope, instead of just passing it along to their shareholders, won't prevent another crisis. It will only hasten the next one. Madam Chair, I look forward to hearing your answers to our questions. Thank you.
Thank you, Senator Brown. And Chair Yellen, again, welcome here. We appreciate you being here with us today. My understanding is that because today's testimony is the same as the testimony you gave yesterday at the House, that you've requested to waive the reading of your testimony. Senator Brown and I have conferred, and we agree with that, and so we will proceed directly to the questions.
Very good.
And with regard to the questions, I again remind the members of the committee that we have 5 minutes each for questions. And we'll try our very best. We've got a lot of time pressures today, and we will try our very best to help you keep on course with your 5-minute question period. I'll begin, and first, Chair Yellen, in a speech that Governor Powell gave last week, he outlined a few principles for housing finance reform. As part of the discussion, he explained that it was important to do 3 things: to do whatever we can to make the possibility of future housing bailouts as remote as possible, to change the system to attract large amounts of private capital, and to identify and build upon areas of bipartisan agreement. Do you agree with these principles?
Yes, I do, Chair Crapo. I would support the principles that Governor Powell put forward and think it's something that I hope the Congress will move to in the near future.
Well, and I know the answer to this, but I'd like to have you say it. Do you agree with the urgency that he expressed and that many of us have expressed about the need for us to act?
Yes, I mean, it's been almost a decade since Fannie and Freddie were moved into receivership, and the role of the government and the associated systemic risk remains. And I think it's important to move forward with reforms.
Thank you. There appears to be growing consensus that Congress should consider changing the $50 billion SIFI threshold, also changing the Volcker rule, exempting certain institutions from company-run stress testing requirements, and reducing the burdens on community banks and credit unions. Do you agree that it would be appropriate for Congress to act in each of those areas?
I do.
Thank you. And could you please give the committee, after this hearing, I don't want to use up my time on this right now, some additional suggestions of ideas or legislation the committee could consider to reduce the burdens in these areas?
Yes, we'd be happy to do so.
Thank you very much. Next, at our hearing last month, Governor Powell said the Federal Reserve is reviewing the Volcker rule. He noted that there is room for eliminating or relaxing aspects of implementation regulation that don't directly bear on the Volcker rule's main policy goals. Can you elaborate on the Fed's review of the Volcker rule?
Well, we look forward to working with the other agencies that have a role in rule writing. It's a very complex rule, partly reflecting the legislation, but I think we could find ways to reduce the burden, and it should be a multi-agency effort.
And many of us are aware that the multi-agency effort has been slowed down, simply, many of us believe, because of the complexity of getting 4 or 5 agencies
that's true.
To all agree on the same thing.
Yes.
What do you think about the idea of having a designated lead agency on this issue?
Well, I think that's something that Congress could certainly consider if one agency has a larger regulatory role with respect to those institutions. Might be natural for it to take the lead.
All right, thank you. And at our last hearing, you told me we would like our balance sheet to again be primarily Treasury securities, whereas we have substantial holdings of mortgage-backed securities. However, the FOMC's plans to reduce the balance sheet include initially not reinvesting $6 billion of maturing Treasury securities and $4 billion of agency securities per month, suggesting that the Fed may wind down its Treasury portfolio more quickly than its mortgage-backed securities portfolio. Is that accurate?
Well, ultimately, when the caps are fully phased in, my guess is that they won't be binding and that we'll be running down mortgage-backed securities at the rate that principal is received on them. It will be a long process, I should say, to go back to an all Treasuries portfolio, even after we've come to the point where our balance sheet has been reduced to as low a level as we expect to take it. We'll still have substantial holdings of mortgage-backed securities. So beyond that, we will be further running down mortgage-backed securities and replacing them with treasuries. So it will be a lengthy process, but the FOMC is committed to a primarily treasury-only portfolio in the longer run.
All right, I appreciate that. And with that, I'll yield back 18 of my seconds and go to you, Senator Brown.
Setting a high standard. Thank you, Mr. Chairman. History teaches us that when Congress does big things, labor law reform and Social Security with Franklin Roosevelt, 1965, Lyndon Johnson with Medicare, that Congress 2 or 3 years later goes back to those issues bipartisanly and makes modest changes to fix them, something we've been asking for several years, asking Republicans to do with the Affordable Care Act. They've not chosen to work with us bipartisanly to make minor adjustments. The same with Dodd-Frank. Instead, we've seen particularly a House Financial Services Committee that wants wholesale destruction. Of course, we will work with bipartisanly on making the kinds of changes that will do what certainly Chair Yellen has spoken about in making those reforms. So I just wanted to preface with that. Madam Chair, you recently stated you do not expect another financial crisis in our lifetimes. Setting aside the delicate question of your and my and all of our life expectancies, is that predicated on maintaining the strength of the current regulatory structure?
Well, let me state what I think I should have stated originally when I made that comment. I believe we have done a great deal since the financial crisis to strengthen the financial system and to make it more resilient. I think we can never be confident that there won't be another financial crisis, but we have acted in the aftermath of that crisis to put in place much stronger capital and liquidity requirements for systemic banking organizations and the banking system more generally. I think our stress testing regime is forcing banks to greatly improve their risk management and capital planning. It's giving us assurance that even if there is a very significant downturn in the economy, that they will be able to function and provide for the credit needs of the economy. And we've greatly increased our monitoring of the financial system for a broader range of risks. But let me say, we can never be confident that there won't be another financial crisis. But it is important that we maintain the improvements that have been put in place that mitigate the risk and the potential damage.
Thank you. I just want people listening not to read your answers from the chairman about moving on reform and moving that there is some urgency to that, and we do want changes. We want them to be modest. But let me sort of further paint that picture with this question. If, in light of your comments to me that you may not expect another financial crisis in our lifetimes, but the importance of a good regulatory structure
Absolutely
diminishes the chances dramatically. Well, if the recommendations of the Treasury report that you're familiar with, that obviously from the way it was written, you didn't seem to have a lot of input in, the recommendations of the Treasury report that weaken regulations on the largest banks, including lower capital requirements and fewer consumer protections, if those were adopted, would you continue to have that same level of confidence that you just repeated and have said earlier?
So I wouldn't be in favor of reducing capital for the most systemic banks.
And consumer protections?
I think those are important as well. There are a lot of things in the Treasury report that we agree with that mirror things that we're doing on our own to appropriately tailor regulations.
I apologize to
But for those banks, it's critically important to maintain the capital standards.
So if we were to adopt I'm sorry to interrupt, if we were to adopt the Treasury report recommendations, it would more likely result in a potential financial crisis.
Well, some of them, yes.
Okay. Last question I wanted to ask. I want to return to a topic I discussed several weeks ago with your colleague, Governor Powell. Last year, the Fed proposed adding capital surcharges into the large bank stress test. Former Governor Tarrillo recently said the biggest bank's capital requirements, quote, are still somewhat below where they should be, and that, unquote, incorporating the surcharges into CCAR will protect against contagions for contagion from one of these banks spreading to the rest of the financial system. Madam Chair, is the Fed on track to finishing these changes?
We're working very hard on those. We're awaiting further work by our staff. We hope to include those surcharges and make other adjustments and to better integrate the capital requirements relating to the stress tests into our normal capital regime.
And you are assuming then, can you give us with insurance, and Mr. Chair, this will be the last, and this is an easy one, where can you assure us that those changes will be in place for next year's stress test?
It depends on the timing. We will need to go out with the proposal, and I can't guarantee that it will be in place that quickly.
But you don't see the Fed heading in the direction of the Treasury report recommendations instead?
The Treasury report is supportive of integrating a capital buffer relating to the stress tests into our regular risk-based capital requirements, but probably is not supportive of including the GSIP surcharges.
Yeah, more than probably. Thank you, Madam Chair.
Thank you. Senator Shelby.
Thank you. Welcome again, Chairman Yellen. In the area of inflation calculations, which you have to deal with, and price stability, which is very important to all central banks and to us. Current Fed calculations show that inflation has fallen to 1.4%, I believe. This statistic is puzzling to some economists, as interest rates were recently raised in June. Some have suggested, you're aware of this, that the Fed should not continue the practice of gradually raising interest rates because inflation has not kept pace as with some of the things that you had talked about earlier. You said in recent testimony, and I'll quote, "It appears that the recent lower readings on inflation are partly the result of a few unusual reductions in certain categories of prices." Your quote, your words.
Yes.
In addition to these few unusual reductions here, is it possible that certain aspects of foreign economies, such as slow growth and soft prices in China, are artificially lowering or influencing inflation in this country? Or what is it? What's going on here? Do you know, and if you know, what do you believe?
Well, with respect to the global economy, we've been through a period in which there's been a substantial appreciation of the dollar, and that depressed for quite some time import prices. But that trend has now come to an end, and import prices are rising at a modest rate. So I don't see the global economy as, at this point, mainly responsible for the low inflation readings. You know, as I indicated in the quote that you mentioned, I do think there is some special one-time transitory factors, these unusual changes reflecting the move to unlimited data plans for cell phones and large declines in some prescription drug prices. There may be more going on, and we're watching inflation very carefully in light of low readings. I think it's premature to conclude that the underlying inflation trend is falling well short of 2%. I haven't reached such a conclusion. We are watching data very carefully, and I would say I regard the risk as being two-sided with respect to inflation. On the one hand, we are seeing low inflation numbers for several months. On the other hand, we have quite a tight labor market, and it continues to strengthen. And experience suggests that ultimately, although with a lag, we're not seeing very substantial upward pressure on wages, but we may begin to see pressures on wages and prices as slack in the economy diminishes. So I see the risk with respect to inflation as being two-sided, and with respect to how that bears on policy, most of my colleagues and I, when we looked at this matter in June, even recognizing that we've had several months of low inflation readings and that we're focused on trying to understand it, have felt that it probably remains prudent to continue on a gradual path of rate increases. But it's something we will watch very carefully, and I want to emphasize that monetary policy is not something that's set in stone, and if our evaluation changes with respect to inflation, that will make a difference.
This economy has been in an expansionist mood for quite some time. A lot of economists say this is a mature economy. Would you disagree with that? Do you believe this economy has got a lot more zip in it?
Well, we've had a long expansion, and the unemployment rate is now at really quite low levels in an historic sense. But I do not believe that expansions die of old age. There are shocks that impact the economy, and a negative shock could end the expansion, but I don't see anything inherent in the nature of the expansion that suggests that it will come to an end anytime soon.
My time's about gone. What significance is the continuing lower price of oil and gas in our economy? I know you exclude some of this from your basic monthly calculations, but it does have something to say and do about our economy because so many things go into oil and gas.
Well, it's the low prices of oil and gas have translated into gains to households. It's boosted their ability to buy other goods and
Very
services.
positive, is it not?
Excuse me?
Overall, very positive in the country.
I think on balance it's a positive. Now,
Sure.
oil prices have rebounded off their very lows, and that's meant that drilling activity is picked back up again, and that's something that is supporting investment spending and demand in the economy.
Thank you, Mr. Chairman.
Thank you, Senator Menendez.
Thank you, Mr. Chairman. Madam Chair, thank you for your service. When you were here last in February, we discussed the economic impact of loss of access to health insurance. You said then that large-scale loss of access to health insurance could have a significant impact on household spending for goods and services. That could also impact job mobility, making it more difficult for people to leave jobs for new positions or to start a new business because they would be risking their access to health insurance. Is that a view you still hold today? And if so, could you explain why?
So I really can't quantify any of those effects, but clearly spending on health care is an important aspect of household budgets, and changes there could have an effect on spending on a wide range of goods and services in the economy. And access to health care is important. I think research suggests that a certain amount of so-called job lock reflects a desire of workers to hang on to employer-provided health care. I can't tell you quantitatively, however, how important that is.
In your testimony, you mentioned that possible changes in fiscal policy and other governmental policies in the United States represent a source of economic uncertainty.
Right.
Would you include potential changes to our healthcare system as one of the factors causing uncertainty in the economic outlook?
Yes, I think fiscal policies generally are associated. The level of policy uncertainty is quite high at the moment.
So I certainly believe that if a potential 22 million more Americans are uninsured by 2026, that it's going to cause premiums to skyrocket for middle-class families and those nearing retirement, that's going to have an impact on the economy. New Jersey alone would see 1 million more uninsured under the Republican proposals, a 47% increase in uncompensated care, $18.5 billion lost in federal funding, the elimination of nearly 100,000 jobs. I think that has an impact in the economy. Let me move to a different topic. What would be the consequences of weakening or eliminating, as some have suggested, the Federal Reserve's full employment mandate, particularly for those workers, many of them minorities, that have been left behind in the recovery and continue to face barriers in the job market?
Well, I believe that the strengthening of the job market that we've seen over the last several years has been particularly beneficial to minorities. Our monetary policy report points out, and this isn't the first time we've done this, that even in a so-called full employment economy, unfortunately, African Americans and Hispanics typically have higher unemployment rates, substantially so, than other
If I may, but
other
my
groups.
specific
But
question is, what would be the elimination or weakening of your full employment mandate mean to those communities? If the Federal Reserve, either by some suggestion, eliminate the full employment mandate that the Fed has, or weaken that as one of your core missions, what would be the consequences?
Well, I do believe it's an important mandate that keeps us focused on the labor market and wanting to ensure strong performance, and we have been very focused on it. Of course, we also have a price stability mandate. Now, inflation has been running below our 2% objective now for many years, and so there has not been a conflict between our price stability and employment mandates that we've
And I'm
faced,
not
but
suggesting that, but I'm simply suggesting that if you were to eliminate or weaken that, wouldn't that have a negative consequences?
it most likely would.
Okay, and then let me ask you finally, how does we see rising levels of household debt, widening inequality, a neutral interest rate at historically low levels, and to me it's critical that the Fed have the ability to respond in the event of another economic decline. How does below target inflation impact household debt, and what signs do you see of inflation coming close to the Fed's 2% target, let alone exceeding it by dangerous amounts?
So as I said, I think the risks with respect to inflation are two-sided, but we're very aware of the fact that inflation has been running below our 2% objective now for many years, and we're very focused on trying to bring inflation up to our 2% objective. That's a symmetric objective and not a ceiling. We know from periods in which we've had deflation, which of course we don't have in this country, but that's something that has a very adverse effect on debtors and can leave debtors drowned in debt. Now, we don't have a situation nearly that serious, but it is important when we have a 2% inflation objective to make sure that we achieve it, and we're focused on doing that.
Thank you, Mr. Chairman.
Thank you, Mr. Chairman. Thank you, Chair Yellen, for being here this morning. Good to see you again. Thank you for your accessibility as well. We've had a number of conversations. We're not always on the same page, but your accessibility is much appreciated. I know the last time we chatted, we talked a lot about the unwinding of the Fed portfolio, which I think today is about $4.5 trillion or so. I think at the beginning of the crisis, it was under $1 trillion. Can you just talk for a few minutes on the timing of the unwinding, and if you have a target number at the end, when would you see us getting there? I think my question is germane to the impact that your objective will have on South Carolinians who are looking for ways to improve their quality of life, and that coupled with the interest rate environment may have a negative impact on first-time home buyers as well as those retirees that have much, if not all, of their money in the market. So your comments I would like to apply to those two specific groups as you discuss this for a few minutes.
Okay, so let me see if I can be responsive to that. Our intention is to shrink our balance sheet and the quantity of reserves in the banking system in a slow, gradual, predictable way. And we've set out a concrete and detailed plan for how to do that. And it involves reducing the extent to which we reinvest principal payments that we receive on our holdings of Treasury and mortgage-backed securities. So when we set the plan into effect, we will set caps on the amount of reinvestment that we allowed allowed to occur. The caps will gradually rise over time, and our balance sheet will gradually run off as a consequence of reduced reinvestment. We want to make sure that we manage this in a way that is not disruptive to financial markets, and in part for that reason, we have tried to set out increasingly clearly and in great detail how we intend to proceed. So once we trigger this process, expect it to run in the background, not something that we'll be talking about a lot from meeting to meeting. It will be a predictable process. Now, we think that our purchases of assets did have some positive effect in depressing longer-term interest rates. And so over many years, as our balance sheet shrinks, we would expect to see some increase in longer-term interest rates relative to short-term interest rates. But, of course, we will take that into effect, namely a steepening of the yield curve, in how we set the federal funds rate, which will become, is now, and I hope will remain, our primary tool for adjusting the stance of monetary policy. And we will set that, as always, with a view toward trying to achieve maximum employment and price stability. Now, finally, you mentioned that our balance sheet was around $1 trillion prior to the crisis, and that's true. But it's important to recognize that although our balance sheet will shrink appreciably during this process, as will the quantity of reserves, I have no expectation of going back to a balance sheet that small. One of the factors influencing the size of our balance sheet...
I have about a minute left, so I hate to cut you off. I want to go to insurance.
Okay.
But let me just say this, that as we talked about the depressing of interest rates, which can be very positive for first-time home buyers, is very negative for those retirees who are depending on the return on their investments to produce their livable income, so to speak. On the insurance side, we talked as well on the importance of having insurance expertise on the FSOC. And as we have all mentioned, I think Mr. Woodall's term expires September 21st or thereabout. Today, the way that we have it structured, we could be absent of any insurance expertise on the FSOC. Would you support legislation to, I know that you don't necessarily get involved in politics, but would you support legislation that would head in the direction of making sure that the insurance expertise stays on the FSOC?
So I do think it's important for FSOC to have insurance expertise, and exactly how you go about accomplishing that, I don't have a specific recommendation, but...
Thank you, ma'am. My time is about up. I do want to encourage our Chairman Crapo and Ranking Member Brown to continue their work on making sure that the FSOC has that continuous insurance representation.
Senator Warner.
Thank you, Mr. Chairman. Chair Yellen, it's great to see you again. And let me just say at the outset, it's great to be asking somebody a question that doesn't have to deal with Russia. You know, Chair Yellen, recently I know the Fed moved proactively to scale back the qualitative portion of the CCAR test. And I know former member Cirillo, before he left, also discussed potential further reforms on CCAR, and many of those I support in terms of maybe folding CCAR into the annual, more the traditional annual review, so it's not on a dual-headed. I do think, though, that CCAR for the largest institutions is important, and in a sense not broadcasting the methodology you're going to use before you do the test is important. I'd like you to get your views on that and how you see the either that continuing reform, which I know you've already gone ahead and moved proactively for banks under $250 billion. Do you see more reform, and is there some value for continuing to keep CCAR in place for the largest institutions?
So I do believe our stress tests and CCAR have very substantially strengthened, especially the largest banking firms. And I think we've, in the process, gained assurance that these firms have enough capital to be able to survive a very adverse, stressful scenario while continuing to provide for the credit needs of American households and businesses. We've looked carefully at CCAR and how we conduct the stress tests, and we're continuing to do so, are open to making changes. But let me say that conducting these stress tests in a rigorous way and making sure that firms have the capacity to be able to meet our capital planning expectations, which CCAR has facilitated, is critically important to having a sound financial system. I can't really see our putting the models into the public domain. We have been making public the results of the stress tests. I think that's an important part of transparency that's strengthened market participants' understanding of the strengths and weaknesses of particular banking organizations, and I think it's something that's helped to provide market discipline. We have tried to make it less burdensome, as you noted, for the under $250 billion institutions. It's conceivable that one day, if the largest institutions were to show on a regular basis that they have in place very strong capital planning standards that meet our expectations, that perhaps we could change the qualitative portion of the review for some of them, as long as we had that assurance. But that remains an open question, and this is a core part of our supervision that's essential.
And I commend in terms of moving up to 250, and I even say there may be regional banks that would be even slightly higher that might be afforded some relief. And I would argue that it's less about kind of annual basis and more would be more triggered by, on the qualitative piece, if they change their line of business or they introduce a series of new products. Obviously, the SIFIs, I think, need this, and I agree with you that broadcasting the methodology on the front end might not be the best way to go. Can you speak for a minute? One of the ways we saw in the crisis was as a lot of financial transactions moved into the shadow banking system. In a sense, and I think we managed to try to scoop a lot of those back in 2008.
We did.
But capital moves fairly quickly. Where do you see in kind of the shadow banking system in 2017 where there may be vulnerabilities or areas that we ought to re-examine?
Well, so we're constantly looking for vulnerabilities and recognize that risk can move outside the regulatory perimeter. I don't have something specifically to highlight. I would note that with respect to shadow banking, the changes that we've made with respect to money market mutual funds have reduced what was a very important and destabilizing risk. We've made a number of changes with respect to the tri-party repo market that have reduced risks there. So I do see changes that have been made with respect to shadow banking that have diminished risks, but we are on the lookout for areas where new risks may be emerging.
Thank you, Mr. Chairman.
Senator Cotton.
Thank you. Welcome back, Mr. Chair.
Thank you.
Much has been made about the slow pace of the recovery over the last 8 years. One aspect of the recovery that doesn't get quite as much coverage is the geographically distributed nature of the recovery. It's been concentrated primarily in larger metropolitan areas. In fact, if you look at small business creation, just 20 counties in this country accounted for over half of all small business creation. This is in contrast to 25 years ago in metropolitan counties with more than 1 million people. Growth in new businesses was only 3.9%. In counties with fewer than 100,000 residents, it was 8.4%. Whereas in this recovery, small business creation in metropolitan counties of more than 1 million is 4.8%. Unfortunately, in small counties of fewer than 100, it's negative 1.2%. In Arkansas, we call counties with fewer than 100,000 people counties. because there's only 7 out of 75 that have 100,000 counties or 100,000 people. On page 19 of the most recent report, the Fed states that measures of small business credit demand have remained weak amid stable supply. I understand that bank small business lending is weak and it's never really recovered to pre-crisis levels. In your testimony, you also attribute the outcome to weak small business demand for credit, and you say that the supply of small business credit is stable. But how do we know that the weak lending demand is the cause of this weakness in small business lending, and that, at least to a degree, a contributing factor is not the supply of small business loans being caused by the decline in the number of community banks in places like rural Arkansas?
So we have a number of surveys, including our regular survey on lending standards in banking organizations, that helps us try to distinguish between demand factors that may be affecting the growth of credit and supply factors. And the statement that demand is weak is partially based on that information. We do have surveys like the National Federation of Independent Business that regularly queries smaller businesses and asks them about the problems that they face. And a very small number cite inability to gain access to credit as a significant factor reflecting their businesses, that's affecting their businesses. But community banks are important sources of supply of credit, especially in rural areas, to small business, and we're very committed to working to reduce the burdens that these firms face from regulation, so that they can thrive and they can meet the needs of consumers and small businesses in their communities.
Does your study and analysis show what small businesses do in places like Cleveland County and Dallas County, Arkansas, when their small community banks close or maybe are acquired and then their presence is reduced to an ATM location? So if you're a small business there and you used to rely on your small bank in Cleveland or Dallas County, that bank is no longer there, what's the most common avenue for them to try to seek financing?
I'm not aware of data that bears on that. There may be something. If there is, I will get back to you on that.
Okay. Thank you very much for your testimony. Thank you, Mr.
Thank you, Senator Shelby, and Madam Chair, thank you for your leadership. It's great to have you here. And the last time you were here, we talked about some of the economic, the situation in the country, specifically as it related to wage growth. And even as we've seen fairly steady job growth, we continue to see very sticky, stagnant wage growth. And you indicated that that is partly a result of low productivity, even though over decades, even when we had higher productivity, we saw very unevenly distributed wage growth. And you mentioned that we need to do more in the way of investing in education, job training, whether it's things like apprenticeships, 2-year community colleges, 4 years. And I know you've made comments about that recently. And I hope as we look at the budget here in the United States Senate, we keep that in mind. And additionally, the need to focus on modernizing our national infrastructure, which is another area of productivity growth where I think we could make some progress. And I wish, in fact, we'd started here in the Congress working with the White House on that kind of bipartisan initiative. So I may follow up with you on that. My questions do relate to some of the comments made by the ranking member. Senator Brown reminded us that on the eve of the financial crisis, most people were predicting sunny skies and clear sailing. Didn't see the storm clouds ahead, and that's why we put in place some of these safeguards, these guardrails to try to make sure the economy could grow, but without undue risk in the system.
Yes.
And that obviously is the subject of ongoing debate now. So I just have a couple questions relating to the guardrails, the safety procedures we put in place. Orderly liquidation authority. that was part of the Dodd-Frank. Do you believe it's important to maintain and preserve that provision?
I believe it's essential to maintain orderly liquidation. We saw during the crisis that the absence of a way to resolve a non-depository institution, a systemic financial institution, in an orderly way led to a massive intensification of the crisis. Now, I agree that bankruptcy should be the preferred route for resolving a firm that's in difficulty, and Congress in Dodd-Frank mandated living wills, and that we should work on the ability to resolve these firms under the bankruptcy code. I believe we've made a great deal of progress in getting firms not only to file these living wills, but also to think systematically as in the course of their regular business, how they need to be organized to make them resolvable in the event of distress. We have put in place rules to ensure the most systemic firms have sufficient gone concern loss absorbency, that they could be recapitalized by bailing in debt holders in a situation where they encounter substantial losses. But while bankruptcy should be the preferred route to resolve such a firm, Title II is a very important safeguard. We can't know exactly what the circumstances would be at the time that a firm encounters distress, and that is a very workable approach that I believe we absolutely need.
Thank you. One other question relating to some of the safeguards that were put in place, because some have proposed eliminating either the leverage ratio or the capital buffer. Former Governor Tarullo said not that long ago that applying a simple leverage ratio to banks in exchange for allowing them to escape Dodd-Frank's capital standards would allow banks to ditch safe assets in favor of riskier ones to boost profits. In other words, he and many others have said it's important to maintain both of these measures in order to prevent undue risk in the system. What is your view?
So I agree with that. A simple leverage ratio basically imposes a capital charge on a junk bond that's identical to the charge that's imposed on holding a Treasury bill. And that type of system can result in banks taking on a great deal of risk. So I believe risk-based capital should be the most important form of capital regulation, that's what should be binding, and I see a leverage ratio as a backup catch-all that's there as in a belt-and suspenders approach, but it shouldn't be what drives decision-making in firms. So we have strong risk-based capital. We now have an enhanced supplementary leverage ratio that applies to the most systemic banks. These two things do need to be calibrated appropriately so that the risk-based capital is what's binding, and we are looking at the calibration of that supplementary leverage ratio because it may be that it is high for example, it affects the custody banks and may be having some unintended adverse consequences, but both need to be in place and they need to be appropriately calibrated.
Thank you.
Senator Perdue.
Madam Chair, good to see you again. Thank you for being here and for your service. I just have two quick questions, but the first one, I'm very concerned about global debt. The Institute of International Finance recently reported that their estimate of total global debt is $217 trillion, or more than 300% of global GDP. Is that directionally, do you agree with that directionally?
So I haven't heard that number. That could be, I don't have that number at my
Well, of that, $60 trillion is estimated to be sovereign debt. We have about 20 trillion of the 60 trillion. With that as background, the four large central banks also have their largest historic balance sheets, as you've said before. Japan, China, EU, and U.S. have collectively they're approaching $20 trillion now of balance sheet size. As you talk about reducing the size of the Fed's balance sheet, are you coordinating with these other central banks and looking at emerging market debt, particularly the $300 billion that's coming due by the end of 2018, relative to the size of your balance sheet here in the United States?
Well, I wouldn't say coordinate. We certainly consult with one another and try to make sure we meet regularly and discuss our policy approaches, make sure that other central banks understand how we're looking at our economies and policy options. So I think the major central banks understand the approach that others are taking, but trying to ask in an aggregate sense how much debt is outstanding is something that we're not doing. Our economies are in rather different situations. While we all encountered weaknesses that were sufficiently severe that Japan, the ECB, the Bank of England, the United States, we all resorted to purchases of longer-term assets to support growth. I would say the United States is further along in the process of normalizing monetary policy, well, at least than the Bank of Japan and the ECB.
Are you concerned about the emerging market debt with so much of that denominated in dollars today?
Well, it is a risk. A significant amount of that is in China, but that's not the only country where there is substantial corporate dollar-denominated debts, and certainly that is a risk that we've considered that affects the global economy.
With regard to the Fed's balance sheet, it's currently about $4.5 trillion. Senator Scott just asked earlier, and I didn't quite get the answer. Is there a directional limit or a target that you have set at this point for the size of that balance sheet? You did say that you didn't see a $1 trillion balance sheet again. But is there a target and a time period that you've discussed publicly about the size of that balance sheet?
So we don't have a target for the ultimate size of our balance sheet. What we've said is that we expect the quantity of reserves in the banking system, which is now a little bit over $2 trillion, to shrink considerably. How small reserve balances will become when we're done this process is something we don't know. A lot has happened over the last decade to affect the demand for reserves. And as this process occurs, we expect to learn more about how the demand by banking organizations for reserves has changed. But I do want to point out that the overall size of our balance sheet depends not only on the quantity of reserves, but on other non-reserve liabilities, importantly including currency. Back in 2007, the stock of currency outstanding was around $700 billion, and it now stands at closer to $1.5 billion. And so even if reserves were to shrink to zero, our balance sheet wouldn't go below $1.5 trillion.
So I'm almost out of time. I have one last question. You talk about this is a long recovery we're in. It's been very weak, but it's been very long, almost 9 years. And the typical recovery in U.S. history is about 58 months, about 5 years. So the question I have is, with consumer confidence right now being at a 13-year high, and yet consumer debt, as you just mentioned, has risen again in the last couple of years back to approaching 100% of household income. What are your concerns relative to the strength of this market and the fiscal policy that's coming out of Washington over the last couple of years and even this year relative to a potential correction in this long-standing recovery, the weak recovery? And does the economy have energy to pop and recover from this extended period of weak economic growth?
So I do have a reasonable level of confidence that the expansion can continue, and we're trying to put in place a monetary policy that will facilitate that. Often previous downturns following expansions have reflected inflation rising to levels that are unacceptable, forcing a tightening in monetary policy, and we have a very different situation now with inflation running below our target rather than above it. Of course, as I said, we are attentive not only to downside but also to upside inflationary risks, and we are focused on that. With respect to consumer debt, I think households are generally in a stronger position. Mortgage debt has declined significantly relative to household income. Student debt has risen enormously. But a lot of the expansion of debt is among higher income households with strong creditworthiness, and the burden of debt payments relative to household income is low. So of course, there are risks in some areas there, but overall, I wouldn't point to household debt as something that is, flashing red on a financial stability concern.
Thank you, Chair.
Thank you. Senator Warren.
Thank you, Mr. Chair. It's good to see you again, Chair Yellen. I want to follow up on the letter I sent you last month urging the Fed to remove the Wells Fargo board members who served during the bank's fake accounts scandal. And I appreciate the response you sent me earlier this week, which acknowledges that you have legal authority to remove these board members, and that confirms that you're willing to use that authority if it is warranted. And that's the question I want to get at today. How could removal of these board members not be warranted given the facts that we already know? The 2008 financial crisis showed that the big banks had completely inadequate risk management systems. And after the crash, the Fed established tough new rules for risk management. Those rules imposed higher risk management standards on bigger and more complex institutions, which means that Wells Fargo, by law, had to meet a very high standard. So let's lay this out. The Wells Fargo Board of Directors is ultimately responsible for risk management at the bank. Is that right, Chair Yellen?
That is a responsibility.
Good. So the board is responsible, and here's what they're responsible for under the Fed's own regulations. Making sure that there are, quote, processes and systems to integrate risk management with management goals and its compensation structure, and making sure there are, quote, processes and systems for ensuring effective and timely implementation of actions to address emerging risks. Now, Wells Fargo didn't come close to meeting those requirements. They established impossible cross-selling goals and set up a compensation structure that put enormous pressure on employees to open accounts, new accounts for existing customers. And despite a mountain of evidence that these incentives were leading to the creation of fake accounts, the board did nothing for years. The result was thousands of employees opening more than 2 million fake accounts. So can you explain to me how the Wells board can possibly have satisfied its obligations under the Fed's risk management regulations?
So I'm not prepared to discuss in detail what is confidential supervisory matter. I will say that the behavior that we saw was egregious and unacceptable, and it is our job to understand what the root causes were of those failures. And as I've agreed, we do have the power, if it proves appropriate, to remove directors. A number of actions have already been taken, and we need to conduct a thorough investigation to look at the full record to understand the root causes of the problems, and we are certainly prepared to take enforcement actions if those prove to be appropriate.
Well, I appreciate that, Chair Yellen, because we already know a lot that's just in the public record and that Wells itself has already admitted to, and that, in fact, Wells Fargo's own board commissioned an investigation by the law firm Sherman and Sterling and found that the board was far too deferential to Wells executives on risk management issues and ignored several red flags about the scope of the fake account scandal. So there's already a lot out there in public. And here's what worries me. Time after time, big banks cheat their customers and no actual human beings are held accountable. Instead, there's a fine, which ultimately is paid for by shareholders, not by executives, and certainly not by directors of the board. And nothing's going to change at these big banks if that doesn't change. You know how I know that for a fact? Is because in 2011, the Fed fined Wells Fargo $85 million for illegally steering mortgage borrowers into costlier loans. And the Fed specifically said those illegal practices were caused by, quote, incentive compensation and sales quota programs and the lack of adequate controls to manage the risks resulting from these programs. So the Fed fined Wells in 2011 for failing to manage the risks resulting from bad incentive compensation practices. And what did Wells do? For the next 4 years, immediately after that fine, the board signed off on incentive compensation practices that led to the creation of 2 million fake accounts. Fines are not working with these giant financial institutions. If bank directors who preside over the firing of thousands of employees for creating millions of fake accounts can keep their jobs, then I think every bank director in this country knows that they are bulletproof. And that poses a danger to the rest of us every single day. You have the power to change the culture on Wall Street. I know you care about this issue. I hope you will use that power.
Thank you, Senator Rounds. Oh, excuse me, Senator Sass.
Thank you. Madam Chair, thanks for being here. I'm very concerned about the most recently available data on job openings and job hires. As you probably know, there's 6 million open jobs in America right now, and yet job hire numbers are falling. I hear about this from Nebraska businesses every week when I'm home, the difficulty they have in finding and retaining talent. What do you think the most prominent causes are of the mismatch between job openings and job seekers right now?
So it is commonly the case that with an unemployment rate as low as we have now, that many employers would have vacancies and regard them and report that they're hard to fill. In fact, the fraction of firms reporting that jobs are hard to fill is, in a way, an alternative to the unemployment rate as a measure of labor market slack. So with a 4.4% unemployment rate, you should expect that there would be many firms that would find this. That said, I agree that there is job mismatch, that there are kinds of jobs that firms have had a good deal of difficulty in filling. I often, when I'm asked about productivity growth and problems in the labor market, talk about the importance of worker training programs, education. We routinely hear that there are jobs, for example, in manufacturing, but ones that require skills that those who are losing jobs don't have. And I often, when I travel, look at programs that have been devised in different parts of the country to try to enable workers who are having a tough time finding jobs, fill the jobs that are available. And I've seen examples of nonprofits partnering with state and local government and with local businesses, community colleges, to put in place programs that are linked to job opportunities that fill that gap. With a tight labor market, I hear many more firms telling me that they are doing their own training, putting in place and expanding training programs to try to fill these vacancies.
Thank you for that. I'm trying to get my hands around, though, whether or not we think this is a new normal and somehow economic growth is going to solve this problem, or whether or not we have a set of cultural issues or institutional issues around mid-career job retraining in particular. So Nick Eberstadt at American Enterprise Institute has data that shows that prime age male labor force participation rates have been declining for over 40 years.
Yes.
We've gone from 25 to 55-year-old males non-participating in a seemingly quasi-voluntary way from about 4% 40 years ago to pushing 15% today, I believe. Do you think this is a new normal?
Well, we've had many decades of declining labor force participation by prime age men, and I think this reflects a whole variety of adverse trends related particularly to technological change that's eliminated many middle-income jobs, those that can be replaced by technology, combined with global outsourcing and production. And the individuals that have lost those jobs have found it difficult to acquire the skills necessary to be reintegrated into the labor market. And many individuals with less education are finding it difficult to be placed in jobs that are middle-income jobs. And so this perhaps intensified during the recession, but it is a much longer-lasting trend. And, you know, we've seen now, unfortunately, this is likely tied to the opioid crisis. It's tied to the problems that many communities have, we've even seen an increase in death rates due to deaths of despair, suicide, drugs.
Pardon me jumping in.
Communities, and so this is a very serious matter.
I think there are social maladies all around this that would be valuable to unpack with your input. If we had longer rounds, I would also ask you some questions about the new multi-career economy that we're inevitably headed toward, and the fact that this institution is not at all nimble or prepared to think about what mid-career job retraining institutionalization looks like. But before I'm out of time, I want to ask you just one question on trade. Corn exports from the U.S. to Mexico have fallen 7% just in the last 5 months. Obviously, Mexico has been exploring other trading partners. There's an attempt on Mexico's part to turn from the U.S. toward Brazil for certain grains and other commodities. Do you think that the U.S. rhetoric around increasingly protectionist tone is having a direct effect now on people trying to pre-negotiate other trading partners? And do you have historical examples of moments like this where we're not yet in a trade war, but we seem to be speaking in a way that implies we might go there, and we're already seeing effects on certain agricultural commodities and exports?
I am going to pass, if you don't mind, on this question.
I mind a little bit.
I think this is, this is a matter that's well outside the domain of monetary policy and really is a matter for Congress and the administration.
Well, I was going to ask you to keep your response short anyway, so thank you, Chair Yellen. Senator Donnelly.
Thank you, Mr. Chairman. And Madam Chair, thank you for your service to the country. We greatly appreciate it.
Thank you, Senator.
This is a subject that my colleague, Senator Sass, touched on a little bit, and then you mentioned. And that is, my state, like many others, is in the midst of a severe opioid abuse epidemic. Hoosiers of all ages and backgrounds have been impacted. Families, friends, personal addictions. And it not only impacts health outcomes, but has a real consequence on economic and employment opportunities. The national unemployment rate is at 4.4%, but the labor participation rate has gone down. People talk about the aging population, this and that. How much of a factor do you think the opioid abuse situation has been?
So I do think it is related to decline in labor force participation among prime age workers. I don't know if it's causal or it's a symptom of long-running economic maladies that have affected these communities and particularly affected workers who've seen their job opportunities decline. This is something that has been going on for many decades. Surveys suggest that many prime-aged men who are not actively participating in the labor market are involved in prescription drug use, not always opioids, but we are seeing, as I mentioned, an increase in death rates, which is extremely unusual. I think the United States is the only advanced nation that I know of where in these communities we're actually seeing, especially among less educated men, an increase in death rates, partly reflecting opioid use. And it's obviously a very serious and heartbreaking problem.
I have felt for a long time that, if the job opportunities are there, if we could have somehow trained these individuals and gotten them to avoid this. And I'm not asking you to be a social scientist, but I think you already mentioned this. There seems to be a clear indication or a clear connection between this and the opportunity to go to a job, to get employed, to have success, and to, in effect, have hope and dignity and purpose, it would seem to me.
I would agree with you, and I feel that that's all of those things are bound up in this opioid crisis and are interacting in ways that are really quite devastating for these individuals and their communities.
A little bit different topic, but one that I think is going to become more and more in the front of our windshield, because I think that, if we look and interest rates start to go up, one of my top concerns is the national debt. I think the debt already has an impact on future generations as the cost of borrowing is increasing. I think it's going to get more expensive very soon. It's at $260 billion plus a year. And you look at that, and we have discussions here about how do we fund the National Institute for Health, which is going to cure cancer, cure diabetes, cure multiple sclerosis. And all those funds that we sit and try to figure out how do we get enough of, we're spending $260 billion a year just paying interest on our debt. Is there a tipping point coming up, or is there a point that you look at and you go, this is really, as the interest rates go up and the amount of it goes up, that you look and you go, this is going to have a very, very significant impact?
So fiscal policy, we've long known under current policy, is on an unsustainable course. And as the population continues to age, especially if healthcare costs rise, as they have historically more rapidly than the general price level, we're going to see the debt to GDP ratio rise from its current level of around 75%, which is not frightening but also not low, to unsustainable levels. And the increase in interest on the debt will be a factor contributing to its unsustainability. You routinely see projections by the Congressional Budget Office. They make assumptions about the path of short and long-term interest rates. They project, I don't have the exact numbers, but short-term interest rates rising. My colleagues most recently we publish our estimates of longer-run normal short-term interest rates, which we see is about 3%. Now, that estimate might change, but CBO also sees short-term interest rates rising towards something like that level, with long-term interest rates moving up. And so that is going to be increasingly a factor driving a debt dynamic.
Thank you. And thank you for your service. And 1 week from today, on July 20th, 330 workers, those carrier workers that we've talked about so many times, start to lose their jobs. So please keep them in mind about how we make sure that their chances for success are ahead, and that we have trade laws that stand up for all our workers. Thank you very much.
Thank you. Senator Rounds.
Thank you, Mr. Chairman. Madam Chair, welcome. Once again, we always appreciate the opportunity to visit with you. I was very pleased to hear your expression of concern regarding the enhanced SLRs, and in particular the impact it would have on a series of not a lot of banks, but on some banks that are the custody banks.
Yes.
I'm interested because for mutual fund holders, the costs for those banks is passed on directly to the mutual funds. I'm just curious. I think it's an issue that should be addressed, and I'm just wondering if you've got a time frame or a concept in terms of how to address the increased costs that they have, even though they're holding, as you've indicated, one of the safest assets out there or instruments out there in terms of their use of central bank instruments. Can you talk a little bit about what your thoughts are?
So I would agree with you. We've been in touch and are aware of the issues faced by the custody banks. It's one of the reasons that we're looking at the issue of the appropriate calibration of the enhanced supplementary leverage ratio for those banks. Perhaps it's too high relative to risk-based capital requirements. I'm comfortable with the level of risk-based capital requirements, but this is something that needs to be looked into. Different countries have taken different approaches. One approach is to exempt certain items like central bank reserves from the ratio. Another alternative is to recalibrate the ratio. I can't give you a definite timetable for our reconsideration of this, but it is something where perhaps our regulations had an unintended consequence, and we are looking at that carefully.
Do you feel you have the resources or the capabilities to handle this, or will it require legislation?
My guess is that we would not need legislation. I will get back to you if that's not the
That's
case.
fine. I would appreciate
believe
that.
it's something that we could change by the banking regulators.
Well, I think it does two things. Number one, I think it makes our banks within the United States less competitive with some other competitors elsewhere that don't have the higher rate or the higher requirement. And second of all, I think that cost is ultimately passed on to mutual fund holders, and I think that just simply means one more fee that takes away from their net return. And in either event, I think we should at least examine it, and I think there is room to be able to reduce some of that cost, which is passed on to mutual fund holders.
We're going to have a careful look.
Thank you. Second of all, I'm just curious, there's been considerable debate in the Banking Committee this year about reforming Dodd-Frank and the right sizing of some of the regulations and thresholds that Dodd-Frank established. Heard a number of concerns from financial institutions that arbitrary thresholds set in Dodd-Frank make it difficult for them to do business. The chairperson also mentioned the concerns in his opening statement. Congressman Barney Frank himself admitted in the pitfalls of these thresholds. In a radio interview last November, former congressman said, and I'm going to quote him verbatim, "We put in there that banks got the extra supervision if they were $50 billion in assets. That was a mistake. We should have made it much higher, $125 billion or more, and we should have indexed it." I'm thinking perhaps even looked at other alternatives as opposed to a dollar threshold, perhaps the business model and what the business activities are of the individual institution. With this in mind, and even the fact that one of the architects of Dodd-Frank openly admitted that the current supervisory thresholds are not inappropriate, or that they are inappropriate, could you state here and now that the thresholds either should be raised or we should be looking at perhaps even changing to a business model approach? We did the Taylor Act, or we provided the Taylor Act as an alternative for smaller banks, and that would model the types of regulations based upon the business activity. Could you give us your thoughts, and is it time now to start taking a hard look at changing that?
So we've already said that we would favor some increase if Congress sticks with a dollar threshold, that we would support some increase in the threshold. An approach based on business model or factors is also a workable approach from our point of view. Conceivably, some of the enhanced standards should apply to more firms with lower levels of assets and others with higher levels. So I think either type of approach is something that we could work with and would be supportive of.
Madam Chair, first of all, thanks for being here. We appreciate it, and I appreciate the information that you've provided. Thank you, Mr. Chairman.
Thank you. Senator Cortez Masto.
Thank you, Mr. Chairman. Welcome, Chairwoman Yellen. It's always good to see you, and thank you for your service.
Thank you.
I appreciate your comments with respect to the opioid epidemic, because in Nevada, that is having an impact. We see it, and every time I go home, we are having difficulty in hiring, but there's so much going on with respect to our economy because of it. There's another area I would like to have discussion with you, and that is housing. In both northern and southern Nevada, I also frequently hear concerns about the housing market from my constituents. In northern Nevada, home prices have been rising sharply, and there's a lack of available inventory, particularly for people seeking to become first-time home buyers, and the rental vacancy rates are extremely low. In southern Nevada, we still have the worst rates of homeowners being underwater on their mortgages, and that's even nearly a decade after the recession. And recent data suggests that Las Vegas has the worst rental affordability crisis for lower income households of any major city in the country. Can you opine or just discuss the role that housing affordability plays in the overall health of the U.S. economy? And can we count on home ownership to be the primary source of wealth building for our younger generation like it used to be at one point in time?
Well, housing plays an important role in the economy, although housing construction, residential construction is not an enormous sector. Housing has very important influence on economic performance and on the health of consumers. For such a large share of Americans, a house is their most important asset, and housing prices affect well-being, their wealth, and availability of credit and access to ability to borrow. So the health of the housing market is extremely important.
And let me see, and so talk about it when it comes to the younger generation, because the younger generation that I talked to grew up through the housing crisis, and at one point in time, owning a home was the best investment that you could make. I don't know if they think that anymore. And do you think that is something that is going to be of concern for our future and for the younger generation when it comes to owning a home?
So there's always been a big debate about whether or not it's correct that housing is the best investment that one can possibly make. And I agree with you that in the aftermath of the crisis, views on that are changing. I'm not going to opine on a personal view as to whether or not that's true. But, you know, for all but those individuals with very strong credit, it's extremely difficult now to gain access to mortgage credit. And we do have overall, I would say, a shortage of housing, whether it's owner-occupied housing or rental housing, relative to what you would think would be a normal pace of household formation in this country. As you've said, inventories are low. We have seen a significant pickup, though, in production of rental housing.
Thank you. Let me jump back to another issue that I hear from my constituents. As you well know, the FOMC has raised interest rates 4 times since 2015. This generally, my understanding, helps banks' revenue since they can charge more to lend money. But what I hear from constituents, particularly savers, is they don't see any benefit or interest rate increases that helps them when they want to save their money. And so when do you anticipate that the impact of the Fed's rate hikes will be felt by savers in this country?
So unfortunately, there's a lag in terms of when retail depositors see an increase in their rates. We are beginning to see, for those who hold large CDs, for example, that it's possible to obtain somewhat higher rates. But especially with rates having been so low for so long, I think it will take some time before competition among banking organizations begins to drive up the rates that smaller retail depositors see. I think that will occur, but it will take a while to show up.
Okay. Thank you so much. Appreciate your service.
Senator Corker.
Thank you, Mr. Chairman. Madam Chairman, thank you for being here, and I'm glad to see some of the moves that you're making and contemplating at the Fed. I know there's been a lot of discussion about productivity, and that's been going on for some time. And for many, many years, the only game in town as it related to dealing with the economy was Federal Reserve. Congress was in a place where likely no actions were going to be taken, and so everybody really, with your predecessor and even much of your term, has relied upon the Fed to be doing things to hopefully stimulate the economy and move things ahead, which is too much of a burden for the Fed. I mean, we should be taking actions ourselves. We're finally in a place where maybe, it's not for sure, of course, maybe we will be dealing some things as Congress to deal with fiscal issues, other issues that relate to the economy. One of those coming up could be tax reform itself. So we've been in a situation with low inflation, really below where you would like for it to be, low productivity, below where you would like for it to be. And these are not questions to lead in a particular direction, but is tax reform one of those things that, should Congress pursue it in a productive manner, could be really helpful to as collateral to move the economy ahead in a much more rapid way?
Well, I would certainly agree that appropriately designed tax reform could have a favorable effect on productivity. Of course, it obviously depends on the details of what you do, and I don't have numbers to give you, but certainly there are distortions in the tax code that I believe are negatively impacting productivity, and so I think there is scope there to have a favorable impact on long-term economic growth.
So one of the things that we're going to be debating on both sides of the aisle, we've got, we've got huge fiscal issues as a nation. Obviously, constraining spending is one of the ways we all, I'm sure in appropriate manners, want to look at to keep our deficits down. But growth is really the easiest way to move away from the issues that we have. Mr. Mulvaney was in my office this week. Tax reform is beginning to be something of discussion, and I know that the current administration wants to see growth get into the 3% range to move beyond where we've been for some time. And is tax reform, from your perspective, something that, again, if done properly, has the ability to move us into a much higher growth rate here in the United States?
So, as I said, I think it is something that could have a favorable impact if appropriately done. Productivity growth is something, it's very hard to move. And if you put in place a policy that predictably raises productivity growth a few tenths, you would probably regard that as a very good payoff. So the numbers typically that studies show, when you do have a positive impact on productivity, they're not 1%, they're not 1.5%. It's hard to raise productivity growth. So I think it moves in the right direction, but it is challenging given the last 5 years productivity growth has averaged 0.5%. The last decade, something like 1.1%. So overall growth for the economy is productivity growth plus growth of the labor force. Labor force growth is declining. It's quite low. Right. It is challenging to move productivity growth up that much, but I hope that Congress and the administration will focus on changes that will succeed in accomplishing that.
And how much would productivity growth need to be to achieve a stable economic growth of 3% GDP growth?
So I don't have the precise number for you, but it would probably have to rise to something over 2.
Productivity over 2 to get economic growth to 3.
Right, given that labor force
And just based
growth is
on,
not-
again, these are not leading questions because we're going to have a significant debate about that, about this soon. Do you think it's achievable for us, based on all the things that you see right now, to even achieve a 3% growth in the near
So
term,
I
in the next 5-year period?
So I think it's something that would be wonderful if you can accomplish it. I'd love to see it. I think it's challenging.
You think that would be very difficult?
I think it would be quite challenging.
Thank you, Mr. Chairman.
Thank you, Senator Heitkamp.
Thank you. And Senator Corker gave you, welcome.
Thank
Let's
you.
start there. Gave you a 5-year window. How likely is it that we're going to see a 3% growth in the next 2 years?
Well, I think that would be
Quite challenging.
Difficult.
Yeah, we heard that. So I think there's strategies we should all pursue, because I think it's got to be one of the goals in fiscal and monetary policy to look at what we can do to get out of the flat growth rate of 2%. And I think there's a lot of people now basically saying we're in a perpetual 2% growth, too mature, the economy's too mature, the economy's too sluggish to ever get there. And so I think it's critically important that we examine strategies together on very real strategies, not make-believe, which just, asking for productivity so you can mask a political agenda. So I'll just leave it there. What percent of export growth in the last 2 years do you think has been related to commodities and agriculture?
I'm sorry, I don't have that number in front of me. I can get back to you on it, but
That would be great, because I think what you're going to find is that when you look at export growth, one of the great stories has really been an increase in exports of oil, an increase in exports of energy, and certainly agricultural exports are always a great story when we're talking about balance of trade. Unfortunately, right now, as you know, commodities are getting particularly hard hit. Yep. North Dakota is a commodity-dependent state in a lot of ways. And the dollar values being high never help us, in my opinion. But we're challenged with bad weather, but we're also challenged with a lot of uncertainty in the trade sector. Are we going to continue to have the trade regime that we currently have in NAFTA? Are we going to be able to do things within a bilateral context in the Asia-Pacific rim that will replace, in fact, the promise of TPP? These are all great challenges. How do you see the trade disruption, trade policy disruption, having an impact on agricultural exports and commodity prices?
So I really don't want to wade in detail into trade policy, which is the responsibility of Congress and the administration.
But you would agree that it is part of, trade policy is part of our opportunity for economic growth, part of our overall economic, a critical component to our economic growth. You would agree?
It certainly has been.
Okay. When you're I think we all understand the benefit of low commodity prices in terms of bringing down cost of production for companies, and it's increased the disposable income for consumers. But at the same time, we haven't seen the type of boost to the economic growth in GDP that you would suggest, just even taking a look at what's happened with gasoline prices, what's happened with natural gas prices as either an input in the chemical industry or as a major component of manufacturing costs. How are you weighing this tension as you consider further reduction in the Fed's balance sheet, along with possible hikes to interest rates?
So we're considering the overall economic outlook relative to our objectives of maximum employment and price stability. And commodity prices, energy, oil prices certainly feed into our view of the outlook. For example, the huge decline we saw in oil prices is certainly something that substantially depressed investment spending in the United States, although it was a plus for consumers. we're now seeing a pickup in drilling activity, which is supporting spending on plant and equipment. But we need to look overall at all sectors of the economy. And I guess I'd summarize that by saying, although there are varied trends in different sectors, this year we've had 180,000 jobs a month. Last year, slightly more, about 190,000. This has been going on for a long time. It's been, we can't really control the distribution of jobs across sectors that are created, but it has been driving a stronger and stronger labor market with unemployment rates that are now at close to historically low levels.
Just to lay down a marker, I would suggest that the reduction in commodity prices, the challenges of the commodity industry, whether it's agriculture, whether it's energy, when you look at job growth in those very difficult times after 2008, a large percentage of that job growth was equated to energy job growth. And so it's critically important that we not just look at one side of the equation.
Sure, absolutely.
And that's the point that I want to make. And any analysis on commodity prices in the context of the greater national economy and productivity, and maybe any little statement you can make on trade, we'll follow up with questions. Thank you so much, Chairwoman.
Thank you,
Senator. Senator Tillis.
Thank you, Mr. Chair. And I want to thank Senator Cortez Masto for consistently in the right committees bringing up the concern of affordable housing, both home ownership and affordable rental housing. And I share virtually all the sentiment I've heard in every committee that she's spoken on it. I want to get back to, I wasn't planning on it, but Senator Corker brought up some things that I'm very interested in, because we do have to increase productivity. And at least in North Carolina, when we were in a financial crisis and a fourth quartile state performer, we figured out a way to do that, which had to do with tax code and regulations. Now, I want to go back to regulations first. I think probably since Dodd-Frank, when I met with Chair Greenspan a year and a half ago or so ago, he mentioned that up to that point, since Dodd-Frank, some 350,000 jobs have been created that are called regulatory compliance, in the category of regulatory compliance. In your judgment, is that a job that improves productivity?
Well, look, we put in place regulations to serve important
I understand that, but I'm just saying,
social.
in your professional judgment, does a job that relates to regulatory compliance contribute to productivity?
Well, it is a cost of doing business.
Okay.
And
So-
it's imposed, but for reasons that produce presumably benefits.
Yeah, I understand. It's just, if we take a look at, there are various ways that we're going to stimulate growth. One of them will be, and I'm going to get on tax code, one of them will be by, incenting capital investment, improving productivity, the things that you can do by maybe clearing up or eliminating some of the distortions in the tax code. But we also have to be mindful, to the extent that the regulatory burden exceeds what we think is minimally necessary to ensure compliance with areas that represent risk, then that's also capital, or that is potential capital that could be deployed to productivity rather than to maybe overly burdensome regulations. Would you agree with that?
Yeah, I think all regulators should be attentive to burdens and seek ways to minimize them.
And if I have time, I'm going to go back to something. You've been very generous with your time, by the way. I should have thanked you for taking the time to meet with my office and responding to questions that we've submitted after committee meetings. I appreciate it. I've enjoyed the discussions very much. But now, could you drill it? Tax reform is something that we spent a lot of time on, not in our first 2 years in North Carolina, because we sought to relieve regulatory burdens first to produce economic activity that would ultimately fund real tax reform. But here we're going to move to tax reform, I hope fairly soon. You mentioned that there are certain distortions in the tax code, if they were dealt with properly, would probably have a positive impact on productivity or economic activity. At a high level, I'm not asking you to do our job by creating an agenda for tax reform, but at a high level, could you give me some insights into the areas that you think are probably worthy of the most scrutiny as we go forward with tax reform?
So again, this is an area I really want to be careful not to wade into and give you any type of detailed advice. But I would say that there is general agreement that there are distortions in the corporate tax code and opportunities for improvement.
Now, I want to go back in my remaining time. This is something that Senator Rounds touched on, and I think probably other members did before I came here. I had two competing committees, so I'm sorry I wasn't here for your full testimony. But if you imagine that, all the tools that you currently enjoy post-Dodd-Frank, so stress test, enhanced prudential standards, living wills for banks, for the largest banks, if they'd been in place before the crisis, do you think that the crisis that we have experienced would have been substantially, that the scale of the crisis would have been substantially reduced?
So that's a difficult judgment to render, but I do think we have much stronger capital, much stronger liquidity. I think it's important to recognize prior to the crisis, we had many significant, large, standalone investment banks that were very highly leveraged.
Yeah, and now because
they're part of banking.
I try to develop a reputation for being close on time. I want to close because I got a great response in the meeting, so I won't in our personal meeting, so I won't ask you to repeat it. But what I'd like to see are right-sized applications of these regulations. I would like to see rational thought placed in how these regimes are applied to institutions, not based on some arbitrary number of, say, $50 billion today or $250 billion, whatever the number. It seems to me that should only be a data point, and the nature of the businesses and the risk that they represent should be the driving factor in going forward and right-sizing these regulations, some of which I think are absolutely essential. Do you agree?
I do agree with that, and as I said in response to an earlier question, one way that Congress could approach this is to increase these dollar cutoffs.
Yeah, but I'd
an
like
alternative is to look at individual organizations and the factors that determine their riskiness.
I'd like to get to a more elegant. I think one of the things we'll do is probably maybe put more meaning to that, because I think everybody agrees in the abstract, but we really need to get to a point to where you regulate based on the risk of the specifics of a targeted business. Instead of us feeling like we index, let's say we raise the number from 50 billion to whatever and then index it over time, we could pretend that we're done, but I think we're missing the opportunity to make sure your resources are focused on the areas that represent the most risk and away from the businesses that don't. Thank you, Mr. Chair. Sorry I went over.
Thank you, Senator Kennedy.
Thank you for your service, Madam Chair.
Thank you.
I think I read the last couple of days that first quarter growth, excuse me, had been readjusted to 1.4%. Does that sound right?
Yes.
Yeah. If you had unfettered discretion, what would you do to improve on that?
Well, growth is variable from quarter to quarter, and we expect significantly stronger growth in the second quarter. So I would certainly, in looking at the performance of the economy, smooth through the volatility. But doing that, we have an economy that is grown over the last number of years by about 2% per year. And 2% has been sufficient to create a very large number of jobs and a tighter labor market. Of course, it's good to have more jobs and a tighter labor market, but the fact that that could be accomplished with 2% economic growth points to what is very disappointing, namely the potential of the U.S. economy to grow is very low. Most, I believe, CBO in our committee estimates that the economy's longer run potential to grow is currently under 2%.
Okay, but my question, Madam Chair, I apologize for interrupting. My question is, if you had unfettered discretion and we're averaging 2% growth, and you wanted to get as close to 3% as you could, which would be considered normal before 2008, if you had unfettered discretion, what would you do?
Well, this is really not a job for the Federal Reserve. It's a job for Congress and the administration.
No, I'm asking for your
And
advice.
my advice would be to focus on all of those factors that determine productivity growth, and that pertains to tax reform and the efficiency with which the economy operates. I would focus on training, on education, the quality of human capital in this economy. I would focus on investment, both public and private. I would focus on policies that impact the pace of technological change and research and development. And there are a wide range of policies that bear on everything in my list. And so it's that set of channels that I think is important in boosting the economy's potential to grow.
Okay. Did we make a mistake moving away from Glass-Steagall?
I don't believe that Glass-Steagall was responsible for the financial crisis, so I don't see that as a major issue that was responsible for the financial difficulties.
Did our move away from it contribute at all, or was it just irrelevant in your judgment?
Well, look, the largest distress was suffered at standalone investment banks like Bear Stearns and Lehman that was a product of Glass-Steagall. The fact that those investment banks are now, all major investment banks are part of bank holding companies and subject to stronger capital regulation is an important safeguard.
Okay. Has the Volcker Rule worked?
The Volcker Rule was designed to stop proprietary trading in banking organizations. That's a goal with which I agree, and it was intended to permit market making. The implementation of it has been very complex and burdensome. We've suggested that community banks be exempt from it entirely, and
should we get rid of it?
I wouldn't get rid of it. I think and I believe the Treasury report suggests maintaining the restriction on proprietary trading in depository institutions. So I wouldn't get rid of it, but I would look for ways to simplify it.
Okay. Last question, quickly. Would you accept a reappointment?
Excuse me?
Would you accept a reappointment as chair?
So it's something that I really don't have anything to say about at this time. I'm really focused on carrying out the responsibilities that Congress has assigned to us, and haven't really decided that issue.
Thank you for your service, Madam Chair.
Thank you.
Thank you.
Thank you. And Chair Yellen, we are approaching 11:30, which was the stop time. I hoped we would be able to meet. Senator Brown has asked for one more question, and he certainly is welcome to do so.
Thank you. And while this wasn't my intent, the first part, if she were reappointed, I would be happy to join Senator Kennedy in supporting your reappointment.
Thank you, Senator.
I'm not sure that he said that, but I think he did. So thank you. And I'm very mindful of the chairman's 11:30 meeting that the Republican conference has. And I'm grateful for his giving me this one series of last questions, which will not take the whole 5 minutes. Dodd-Frank required the CFPB to study forced arbitration, as you know, and to make a rule protecting consumers from the practice if doing so would be in the public interest. In 2015, CFPB publicly released a comprehensive study of the impact of forced arbitration agreements on consumers. The Bureau released a proposed rule limiting the use of forced arbitration in consumer contracts. As you know, on Monday it released the final rule. During that time, CFPB surveyed, consulted with experts at prudential regulators like you. If any of your staff, a couple of questions and then one brief comment. If any of your staff had safety and soundness concerns about this rule, do you think they would have raised those concerns with the CFPB during the rulemaking process?
So I know my staff consulted, and I assumed that they would have, but I'm not certain just what those consultations were.
Okay. And one more question. If the rule were likely to impact the safety of the U.S. banking system, do you think it would be unusual that no staff of any of the prudential regulators would raise concerns about the rulemaking process?
I assume that they might well have.
Okay. I thought that's why I thought it was unusual, and I was surprised to see the acting controller, Norica, understanding his short time there and short horizon to stay there, that he raised issues with this rule so late in a 2-year-long process and mentioned safety and soundness. And I think the Director Cordray, clearly explained the efforts that CFPB has made to consider input from safety and soundness regulators. So, Mr. Chairman, I just close with asking unanimous consent to enter Mr. Norica's letter and Mr. Cordray's letters on this issue into the record.
Without objection.
Thank you.
And if I'd known you were going to go into the arbitration rule, I might have rethought going back into that issue.
In the CRA, right?
That's right. We will discuss it further, probably. Chair Yellen, thank you again for being here with us today, and we always appreciate the opportunity we have to discuss these issues with you. For senators who wish to submit questions for the record, Thursday, July 20th is the due date, and I encourage you, Chair Yellen, if you receive questions, to please respond promptly. And with that, this hearing is adjourned.
Thank you, Chair Crapo.
Thank you.